All right, so now we're recording, so this will be available for everybody else that goes to do the revision afterwards. So you guys are actually doing the writing, have got the first exam slot out of my module. So your exam is going to be on the 19th of June, which is, surprisingly enough, and it's come so quickly, only a week from today. So 19th of June, and that's in 1 week's time. So this evening is then basically our NSS session for the exam, and I'm going to go over a previous exam paper 2022 with you. I probably won't finish it this evening because it will take quite long to go through the entire paper. So whatever I don't finish this evening, I will carry on and record for you tomorrow, and then also post in a second video, because I don't like these videos to go on for longer than an hour and 20 minutes, because then students don't watch them. So I'd rather split it into two anyway. So that's what we'll do. So I'll go as far as we can this evening in about an hour's the hour's time that we've got, and then the rest I'll record for you tomorrow, so that you've got one full work through of an exam paper that you can use to prepare during this coming week. And then also, just before we start the paper, please remember, any questions that you've got as you do your revision, let me have them in an email or a message on Learn, so that I can help you. Don't battle and don't sit at home when you're doing revision and battle with something that you can't work out what it should be, or why somebody did something the way it was, and then not ask me. Okay, that's what we're here for the questions. Okay, so I've shared my screen, and now I am going to, there we go, open up the PDF file of the question paper with the answers for. So this is, as you can see at the top here, this is this was a June 2022 paper. So in your past papers folder that they post for you guys on in that e-library, they only post one paper per year. So in other words, for 2022, they only would have posted one exam paper. So that could have been a June paper, it could have been a December paper, it could have been one of the sub-papers. I'm not sure which one. So don't panic if the paper that you're looking at here on the screen is not the same as the paper that they've got in the e-library. There are always minimum 3 versions of every exam paper for each exam sitting. So there would have been 3 June exam papers, and there also would have been 3 December exam papers. So that explains why the paper that I revise with you might not always be the same one in the library. Okay, but you're welcome to ask me to help you with whichever paper that you've got. Okay, so then let's go and have a look quickly. I'll try and move through the questions quickly, but at the same time giving you guys enough time to work out what's going on. Okay, let me just go over here. All right. Let me just turn this volume up so I can hear. Okay, so question number 1 was for 20 marks, and this entire question was 20 theory questions, each for 1 mark. So it looks like it could be quite easy, but for you guys to remember 20 different theory questions can be quite tough, because remember, you would have had to memorize this work in an exam. You are sitting there, closed book. All you have in front of you is the question paper and your answer book in front of you. So please don't forget, at the beginning of each of your learning units in the module outline, as well as in the learning unit section on Learn, they've got the list of learning objectives, which is the very first screen, that list of bullet points. Those are the learning objectives, which are the learning outcomes, which are the the questions that they will ask you. So they also may not ask you anything that is not a learning objective. So by studying those learning objectives, you know you will have prepared for any theory question that, that they can throw at you. So I'm not going to go through these in too much detail because, so let's just, in other words, I'm not going to do a long explanation of each of them. It will take too long, but we'll read the question and then we'll have a look at what the answer should be. So the first one, this theory was developed by a man named Luca Pacioli. So remember, guys, because it's only 1 mark, don't write a long essay for each of these, because 1 mark represents 1 minute. So you've only got 1 minute of your allotted 180 minutes to answer each one of these questions. So don't spend any longer than that on each question. If you've got to think about it, move on to the next one. You can always come back at the end of the paper if you've got spare time left. But it's vital that you manage your time right from the very first minute when they say, okay, you may start writing. Also, just remember before we start that in this particular paper, for instance, there were 7 questions. So in your 15 minutes reading time that you are given at the start of the exam, you must read through the question paper to go and have a look to see what each of the questions is about and decide which of those questions you know really well and that you could do quickly. And then you're going to start by doing that question first. So you will be given an answer book. So the templates for the answers will be in question number order, but you are absolutely welcome to first do question number 6, then go back and do question number 3, then do number 7, and then do question number 1 last. Remember, it doesn't matter. You don't have to start at 1, then do 2, then do 3. And your whole strategy behind this is that there'll always be some questions that you know really well and that you can do quickly. Those are the questions you're going to make sure you immediately start and do those first. Because by doing that, you'll save up minutes towards those questions that you don't know that well and that you need some thinking time. It's probably the most important strategy that you're going to manage all the way through those 3 hours of the exam to make sure that you pass. It can make the difference between passing or failing the exam by managing your time correctly and doing the questions in the correct order. Okay, so theory was developed by a man named Luca Pacioli. So all you want to write there is the double entry. Okay, remember the theory that he invented was the double entry theory. And then what users of accounting information provide the risk capital. Okay, so that's what they do. The user that provides the capital. And they are interested in the finances of the business because they are concerned with any risk and return provided by their investment. So all they've asked there is what users of accounting. So all you're going to write down is investors. Okay, so it's going to take you maybe 10 or 12 seconds to read the question carefully, and it's going to take you 2 seconds to write the word investors down nice and neatly, and then you move on and you've already saved half of a minute. Then the third question, often referred to as the international language of business. What do we call the international language of business? That is accounting. These are paper-based or electronic records used to transcribe or summarize business financial transactions. So what are the paper-based or electronic records that we use to summarize transactions? So remember your bookkeeping cycle. This is where this question is coming from. And the very first step in our bookkeeping cycle is that source documents summarize transactions. And we then record the source documents into our subsidiary journals, etc., etc. So all they wanted to know was what are those records? So always look for that word. Here they want to know these are paper-based or electronic records. So it was the records that they wanted. So that is source documents. Then our next one is a table used to summarize similar transactions so that we facilitate fewer postings into the bookkeeping system. So this is then going to be our next step in our bookkeeping cycle. The word table might be a little bit misleading, but the table where we summarize similar transactions in our bookkeeping system, those are called the journals. So the journals are cash book receipts journal, cash book payments journal, salaries journal, debtors journal, creditors journal, etc. Each of those journals we use to summarize similar transactions. Then question number 6, the IFRS term used for the goods that a business buys and sells. So here they want, when they say the IFRS term, they mean they want the correct accounting terminology for the goods that a business buys and sells. So we call that trading inventory or trading stock. And you have to get that word correct to get the mark. And then this word that they want for this mark simply means left. And it's the name given to the left-hand side of a general ledger account. So remember, your general ledger accounts are those accounts that we call the T accounts. And the left-hand side is debit. And in your textbooks, it states that left only means debit. It doesn't mean anything else. It's just the name we give to the left-hand side of our general ledger T accounts. And then question number 8 was introduced in South Africa on the 30th of September 1991. The initial rate was set at 10%, then it was 14%, and it's currently 15% from the 1st of April 2018. So what was introduced in South Africa that currently the rate is 15%? So again, keep it simple, and all they want is the word VAT or value added tax. And then what's again the correct terminology that we use for a person or a business that is registered for VAT? What do we call a person or a business that is registered for VAT? We say that they are a VAT vendor. And you'll be able to pick that up in your questions as well, because they always mention in the question the company that you're doing the transactions for is a VAT vendor and only purchases from other VAT vendors. Then question 10, the internal source document, which means the business's own document that they use to record payments that they make out of the petty cash box. So what is the internal source document that we use when we pay money out of the petty cash box? So just the name, and that is the petty cash voucher, or you could also have said a petty cash slip. And then what do we also call the cash receipts journal? Another name for cash receipts journal is just the cash book receipts. And remember, we always use the abbreviation CBR. Oh, wow, that's so tiny. CBR, cash book receipts. Then question number 12, what summarizes the subsidiary journals and is a collection of all of the accounts that we've got? Okay, so again, going to your bookkeeping cycle, we have source documents that are recorded in journals, then the journals, subsidiary journals, are then summarized into the general ledger. Okay. At the end of the month, we summarize all of our subsidiary journals into the general ledger. 13, and under this system, so it's obviously then the name of the system that they want, we debit an expense account called purchases when trading inventory is acquired. Okay, so when we purchase inventory, if we debit the expense account called purchases, instead of debiting the asset account trading inventory, which system are we using when we debit purchases? That's then going to be the periodic inventory system. So all of these questions are based on learning objectives, because one of your learning objectives is to know the difference between the periodic and the perpetual inventory system. So, and one of your learning objectives is to know that bookkeeping cycle. So if you know all of those, all of these questions are coming out of those various learning objectives. Question 14, this consists of a series of individual debtors accounts. So we've got a whole series of individual debtors accounts. Those are people that we sell to on credit. And it's got a completely different structure to the accounts in the general ledger. So what do we call this collection of the individual debtors accounts? We call this the debtors ledger or the accounts receivables ledger. Okay. Then question 15, what do we call when we take the basic salary of an employee, we add all of their fringe benefits for the month? What is that total called before we take off any deductions? That's their gross salary. So everything that an employee earns, all added together, is called the gross salary. And then after we've taken off the deductions, that is then called the net salary. Okay, so gross salary is all of the employee's income minus all of the deductions is then called, what's left over is called the net salary. PAYE is an abbreviation for what? So they want you to write that out in full, what PAYE stands for. Pay as you earn, which is the income tax that the receiver takes from employees, and it's called pay as you earn because you pay the tax every single month when you receive your salary. So as you earn your salary, you pay the tax every month. Then question 18, this is a statement form of the accounting equation, and it is drawn up to disclose the financial position of the business to all of the stakeholders of the business. So this is the formal IFRS financial statement that in essence is a summary of the accounting equation, and this allows us to discern the financial position of the business. So again, we want the correct formal name of the statement. So 18 is the statement of financial position, which is what it's currently called with IFRS. The old-fashioned name for that is the balance sheet. Then sales and cost of sales are closed off to which account at year end? So as part of your year end journal entries, the very first journal entries we do, we take sales and cost of sales, and we close them off to one particular general ledger account before we continue with the rest. Oh, sorry. That's the trading account. And then the last one, a trial balance that does not contain any of the nominal accounts. So at year end, once we have closed off all of our income and expense accounts, what we're left with then is the trial balance, with no nominal account balances left. So what is that called? The post-closing trial balance. Okay, so remember with that question, it's 20 marks, which you really, really want to get down so that you've got a good start to your paper. But the most important thing with that question one is that you're going to move quickly. Just if you can't think of the answer immediately, just skip it and move on. You can't waste time on a question like that. So if you get a similar question, just remember, plan how you're going to approach the question. Okay, then question 2, which is also for 20 marks. Remember, your paper is going to be out of 180 marks. So that means you've got 180 minutes, which is 3 hours. So question 2.1 is going to be for 10 marks. So that means you've got 10 minutes to complete this, and you've got to bear that in mind. And this is your very favorite VAT calculations. So they have given us 3 columns: the VAT exclusive column, the VAT column, and the VAT including column. So for each line, for each transaction, they have given us one of the amounts, and you have to calculate the other 2 missing amounts. So guys, the very first thing that you're going to do when you get a question like this, which is very likely, is at the top of the column you are going to write, we know that VAT is 15%. We know that the amount before we've added the VAT on is 100%. So we do VAT exclusive plus the VAT, which is 15%, equals the VAT including amount, which is then going to be 115%. So when you write your proportions at the top of each of these columns, it's going to be dead easy to then go and do these calculations. Honestly, if you learn little tricks like this, it's going to help you to not make mistakes, and it's also going to help you to work quickly. So let's just have a look at some of these calculations here. So here they've given us the VAT exclusive amount. So that means the amount before we have added on the 15%. So this one is then easy. The VAT will be 20,000 times 15%. That's your calculation. And then to get your VAT including amount, you're going to take column A plus column B, and that will give you VAT including. So VAT exclusive plus the VAT will give you the VAT inclusive. Don't waste time doing any calculations that you don't have to do. As soon as you've got 2 columns worked out, your third column is just going to be plus or minus the other 2 columns. Okay. Then in the second one, the amount that they've given us is the VAT. So this amount here, 37,500, is 15%. It's the VAT amount, and it is 15%. So in order to work out, let's work out the VAT exclusive amount. We take 37,500, we divide that by 15, which will give us the value of 1%, and then we multiply that answer by 100, and that will give us the VAT exclusive amount. Or we can take 37,500 divided by 15 and multiply the answer by 115, and that will give us the VAT including amount. So whether you do this first exclusive or the inclusive, it doesn't matter. If you've done the exclusive, again, to work out the third column, you would then take column A plus column B equals the VAT including. And if you'd worked out the inclusive first, you would take column C. This here would be column C minus column B would give you the answer to column A. And then the third type of calculation that you can get is if they give you the VAT including amount. So these two are both the same. So if you've got the VAT inclusive amount, this means that this represents 115% because it's the excluding amount, 100, plus the VAT of the 15. So this is the total 115%. So again, that makes it super easy. We know that this is 115. So all you do is you divide that amount by 115 to get the value of 1%. And then you come here and you multiply that answer by 100, or you come here and you multiply the answer by 15. And again, if you calculated this first column, if you did 40.250 divided by 115 multiplied by 100, you've now got the including and the exclusive amount. So to calculate the VAT, you would then take column C minus column A, and that would then give you this column here, the VAT. The next one, your calculation is identical. And with this last one over here, the 18,750, your calculations will be identical to the second row over here. But do you see, guys, I know you really do get yourselves in a big knot about VAT, but it is literally this simple. Just label your columns correctly, and then you just use simple maths. That's really not complicated to then calculate from the amount they've given you. You can then calculate the two missing amounts. Okay, so have a look at how I showed you to do these calculations. And again, the secret to these is practice and practice and practice. So your answer, which side is this now? Would look like this. You obviously don't have to write out the amounts that they've already given you. These are the amounts here that you had to calculate. And the amounts that I haven't highlighted were the values that were given to you. Okay, so just have a look at those amounts that are highlighted and then practice that question to make sure that you can get those same answers. And then the next question is super easy. And again, remember VAT categories is one of your learning objectives. And it's not only just a learning objective, it's something you really have to master so that when you enter your transactions into the various journals, you can get all of your VAT calculations correct. And you can also correctly identify whether you should have VAT in the VAT column, whether you are allowed to claim the VAT or not, or whether the transaction even included VAT or did not include VAT because perhaps it was a zero rated or an exempt item, and that you can't claim the VAT if perhaps it was a non-allowable item. So there's a method. The reason why you have to learn these VAT categories is so that you can enter your transactions into your journals correctly. Okay. So make sure you practice these. It's very important. So let's just use this. So milk, because milk is one of the basic foodstuffs, that is zero rated. Chocolate, Cadbury's or otherwise, even though we would love to have that zero rated or exempt, I'm afraid chocolate is not an essential food item, and so it is standard rated. Petrol is also an essential commodity, so that is zero rated. Interest received, that is a financial transaction, and remember those kinds of financial transactions are exempt completely from VAT. So they're not zero rated and they're not standard rated. There is no VAT on them at all. They're completely exempt. Then club fees. So when a club is, let's say for instance a golf club, when they send the subs invoices out to their members, they will have added VAT onto the invoices, obviously depending on how big the club is, whether if it, let's say the club is VAT registered. Okay, so the golf club is registered as a VAT vendor, which means when they send the invoices out to their members, VAT will be included on that invoice. But if a business is paying golf club or other club fees on behalf of their executives as part of their remuneration, they are not allowed to claim that VAT back as input VAT, because that is then considered entertainment. And anything that a business spends on entertainment, specifically entertainment of their own employees, the business is not allowed to claim the VAT back. They have to pay the VAT as part of the cost of that expense. Then we've got white bread for staff lunches. So if the business has got a canteen and they buy white bread, so remember white bread does include VAT. It's not brown bread is 0 rated, white bread is standard rated. But because they are using that white bread for their own staff lunches, that is also considered entertainment, and so that is also non-allowable. We're not allowed to claim that VAT back either. Okay, so just make sure those VAT categories are incredibly important. And then this last question that they often ask, because it is one of your learning objectives, what are the 2 bases upon which a business can register for VAT? So when a business registers for VAT, there are 2 bases upon which they can choose to register depending on certain criteria. What are those 2? So a business can either register on the payment basis or the invoice basis. So this payments basis is also sometimes called the cash basis, the payments or cash basis, or the invoice basis. And what is the difference between those 2? So also just remember while I'm here, they said name them. So what are the 2? You had to name them. And there was also and explain which would be more suitable for a business that has a turnover of 3 million rand. So a business of that size, should they preferably register on the payments basis, or should they preferably register on the invoice basis? So they say explain which would be more suitable. So obviously you have to decide which one, and you have to give a reason why did you decide that that particular basis was more suitable. So let's just go and have a look over here so that you can read it. So we've got the payment and the invoice basis. So they didn't mention, and they say, I see in the memo here, they say sole trader. In the question, they didn't say sole trader. They just said a business, but we're assuming it's a sole trader. So oh, it does exceed. Okay, sorry, I was misreading this. So this is a sole trader or a business whose turnover does exceed 2.5 million per year. So that means the business doesn't have a choice. They have to register on the invoice basis. Okay, the invoice basis would have to be used. If the business's total annual turnover is less than 2.5 million, then they can choose the payment or the invoice basis. And remember, the difference between those 2 is that the payments basis says that we only claim the VAT back or pay the VAT to the receiver of revenue when the invoice is actually paid. So only when our customer pays us do we then pay that output VAT to the receiver. And only when we actually going to pay the invoice to our supplier do we then at the same time pay that invoice, pay that, claim that VAT back from the receiver. So the payments basis happen, the VAT transaction takes place at the same time that the payment takes place. On the invoice basis, we either pay the VAT to the receiver or claim the VAT back from the receiver the same month that the invoice was produced. So if it's an invoice produced in June, we will then either pay or claim the VAT in June, regardless of if that invoice is only going to be paid in July. So just make sure you understand the difference between the payment and the invoice basis, because sometimes the theory question asks you to explain that. And you also do have to know that 2.5 million is the cutoff for having the choice between payment or invoice basis. Anybody above 2.5 million, all big businesses are registered on the invoice basis. Okay, I'll just take a quick drink of water. Just give me 1 second. Anybody got any questions at this point? Let me just come back here to the chat. Any questions? Any questions at all so far? Remember, this is recorded. So let me just double check it's still recording. Yes, it is. It is recorded. So you'll be able to listen back to this afterwards. Okay, oh, we don't want that one. We want the question. Okay, so question 3, which is also for 20 marks. And guys, you will definitely get one of these questions. You've had them, I think, in both of your assignments, and you are bound to get this question in the exam as well. It's one of the absolute basic skills that you have to learn in first year accounting, and this is why they ask it over and over again. The same thing with the VAT calculations and the same thing with the VAT categories is being able to analyze transactions under the accounting equation. You have to be able to do this because this then proves that you understand your debits and credits, and when do we debit an account and when do we credit an account, as well as being able to calculate the rand values of those journal entries that we are doing. Okay, so we've been given 5 transactions. The required says, analyze each of the above transactions and complete the table as follows. So they've given you an example. So please pay attention to the example and make sure you do it exactly as they've done it in the example. So in the example, the transaction was we paid 200 Rand for our telephone account. So example, the number is the example. We want to know what general ledger account will be debited and what general ledger account will be credited in this transaction. So in this account debited and account credited, what you put into those columns must be the name of the general ledger account. So not the description of the account, not the person's name that was paid. It must be the actual T account, the name of the T account that is getting either the debit or the credit. Okay, remember for our T accounts, the name always goes at the top of the T. Okay, so it's this name that must go here. So what happens when we pay the telephone account? Telephone account is an expense that we are paying. So we expenses always increase on the debit side. So telephone will be debited. We are paying 200 Rand, which means the 200 Rand is coming out of our bank account. Bank is an asset, So that is going to be credited because assets decrease on the credit side. So remember here also, you must know absolutely backwards your dead click little memory jogger. The D means that accounts that increase on the debit side, accounts that increase on the debit side, expenses, assets, and drawings. Accounts that increase on the credit side, liabilities, all income accounts, and the capital account. Okay, so you will learn that, but then your job is having to identify what category telephone is, what category bank is. So you must know that telephone is an expense account because that's an expense that we're paying on behalf of the business. You must know that your bank account is an asset. Our VAT account, VAT input, is going to also be an asset because we are claiming that VAT back from the receiver, which means the receiver owes us that money. So that is then like a debtor in our books, and that is also an asset. Then also you have to know your transactions. So they've just told you that we paid 200 Rand. So that means that 200 Rand is the gross amount that came out of the bank account. So our asset bank decreased by 200 Rand because we are because we paid 200 Rand out of the what am I saying? We paid 200 Rand out of the bank account, so our asset bank decreased by 200 Rand. We are assuming that that 200 Rand is the including VAT amount. So I think they've got something wrong in this example, but anyway, let's fix it for them. So our calculation to work out 200 Rand divided by 1.15 is equal to 173 Rand and 91 cents. And if we subtract that from 200, our VAT amount will then equal 26 Rand. And remember, you're rounding to round correctly, 26 Rand and 9 cents. So this here, owner's equity, should not be 200. That is minus 173.91. So our owner's equity, which is the expense, telephone, an expense account, here expense account decreases owner's equity. So we are decreasing owner's equity by the excluding VAT amount, 173.91. And VAT input is an asset. So assets are increasing by 26 Rand and 9 cents, which is the VAT amount. So each of these transactions look quite simple, but you have to know your dead click. You have to be able to identify each of those accounts correctly as to their category. You have to be able to identify, are expenses increasing or decreasing? Is my VAT input increasing or decreasing? Is my bank increasing or decreasing? So that you get your pluses and minuses correct. And you also have to get these calculations, which are generally VAT calculations, correct as well. So that you get the including VAT amount and the excluding VAT amount and the VAT amount, you get all of those amounts correct. So you can get all of those marks. Okay, so the instructions for this question were, show the double entry, in other words, which account is going to be debited and which account is going to be credited, the general ledger names, as well as, in other words, also the effect on the accounting equation. And remember, your accounting equation must always balance afterwards. So assets equals owner's equity plus liability. So this assets is the left-hand side of our accounting equation, and owner's equity plus liabilities is the right-hand side of our accounting equation. So assets equals owner's equity plus liabilities. And after each transaction, that equation must still be true. So let's have a look at what did we do here. On the left-hand side, I've got 200 minus 2609, which equals in total minus 173.91. Sorry. Minus 173.91 in the asset column. Yep. And then on the right-hand side, I've got minus 173.91 in the owner's equity. So I can see whatever I did to the left-hand side of the accounting equation, I did the exact same thing to the right-hand side of the accounting equation. I decreased the left-hand side by 173.91, and I decreased the right-hand side by 173.91. So I can say that, yes, my accounting equation is still in balance after I have recorded that transaction. So when you guys have done your calculations and you've written the amounts in, always do this check. What have I done to the left-hand side? What have I done to the right-hand side? And are they equal to each other? I must either increase the left-hand side and increase the right-hand side by the same amount, or decrease the left and decrease the right-hand side by the same amount, but it must be the same. So also the instructions, always pay attention to the instructions, because these always will make a difference to the marks that are awarded. Ensure that you use the plus and the minus signs to show the effect, as marks will be allocated for these. It's absolutely vital that you read all the instructions on your question paper. So guys, can you see all I've done over here is go through, work through the required on the paper by breaking down the example and reading through the instructions. Just look how much information was just in that section of the paper. And you can also see how much, how practiced you've got to be in all of these types of questions, so that you are familiar. You know all of these rules, you know what you've got to do, you know your dead click, you've practiced with your chart of accounts, which accounts are expenses, which are assets, which are liabilities. You've practiced your VAT calculations. These are all of the things that you must spend your time doing in this next week while you're preparing for the exam. Okay. So let's just, I'm not going to go through in such detail as I have with this, because I wanted to break this down to really show you how you've got to do each of the questions. So let's just take a quick look at these 5 transactions that they've given us here. So our transaction 3.1, the owner contributed cash of 200,000. So look at the important things are, is that it was actual cash that the owner contributed. So that means the business received 200,000 Rand in cash. And where did the cash come from? It came from the owner. So we know as soon as we see that there is a transaction between the owner and the business, we know that proprietary, I can never spell it. Oh, Heather, you got that wrong. So bad. Proprietary, that's better. Almost. Why can't I spell it tonight? I've gone completely blank. I must be really losing my marbles this time of the year. Anyway, you guys, oh, I know where the mistake is. Gosh. I'm going to have to look that up. Okay, anyway, you guys know what I'm talking about. If as soon as there's a transaction between the owner and the business, the 2 proprietary accounts are involved. And those 2 accounts are drawings and capital. So as soon as you see that there's a transaction with the owner, you know that either drawings or capital is going to be one of the accounts. As soon as you see that cash is involved in the transaction, you know that bank is going to be involved. So all we have to have a look at is, was bank increasing or decreasing? So the owner contributed cash, so our bank increased by 200,000, and then we know that the other side of the entry is the owner's capital account. Here we go. So let me just see where you can see the top of the, so here's our columns. What account was debited, what account was credited, and then over here is our I'm just going to draw a line down here if I can get a straight line so you can see where, okay, to the left hand side we've got debit and credit, and to the right hand side we've got the accounting equation. Remember, it's assets. And write it at the top of your page because it's going to help you, equals owner's equity plus liabilities. So that when you check in your whether what you've done to the equation, you can get that right. And remember also that this was incorrect. This amount over here was, what was the amount that I worked out? I can't remember now. I've written it on the screen, but you've got, so it was 173 something. On 73, 2, 3, 4, I don't know, something like that. Okay. So the account that's going to be debited is bank, because bank is an asset and that is increasing. The account that's going to be credited is capital, because capital is a owner's equity account. It's the proprietary account, and let me just write OE, owner's equity. Okay, that stands for owner's equity. And remember, I'm going to put dead click here on the side so that you can have a look at that. So bank asset is increasing. Capital, owner's equity account, is increasing. So when an asset increases, we debit it. When a capital account increases, we credit it. And both of them are increasing by 200,000. So assets plus 200,000, owner's equity plus 200,000. The next transaction is, let's just have a double check our information at the top here. They're a furniture shop. They use the perpetual inventory system, which is very important. The markup is 20% on selling price, and very importantly, VAT can be ignored. Okay, so in this transaction, there's no VAT. In these transactions, there's no VAT. What does this mean over here? The markup is 20% on the selling price. So that means our selling price remember always our selling price minus our cost is how we work out our gross profit or our profit or the markup. And remember, gross profit or markup, it's the same rand value. We call it gross profit or we call it the markup, but it is the rand value that's left over when we take selling price minus the cost. So they've told us here that the markup, so that means we work out our profit by working out 20% of the selling price. So that means the selling price is going to be 100%, which will make the cost 80, and our markup is 20%. Okay, they told us that the profit is 20%, and they said that it's 20% on selling. Okay, so that means that if it's 20% on the selling, that means the selling price will be the basis, our 100% base. So if the selling price is 100 and the profit is 20, which they've told us that, we know that selling minus cost equals profit. So if selling is 100, in order to get to that 20, we have to subtract 80. So 100 minus 80 equals 20. So always write this little equation down as soon as you've had a look at what your markup calculation is, whether its markup is 20% on cost or 20% on selling. Write your little calculation down, get it the right way around, double check yourself, and then again, you've got no trouble. You can come straight back to these percentages to do all of the calculations that you need to do. Remember, if they had have said that it was the markup is 20% on cost, then we would selling price minus cost equals markup or gross profit. That is still true. So if our selling price is 20% on cost, then cost will be the 100. Whoops. Okay. Markup is 20% of cost. Then our equation would be cost is the 100, markup is 20% of cost, which means that the cost plus the markup equals the selling price. Okay. Cost plus the markup equals selling price. When it's 20% on selling price, the profit is 20% of the selling price, then our cost is selling price minus profit equals cost. So there we had 100 minus 20 equals 80. Just think about that. You've got both the calculations here in front of you. These red arrows are very important. Okay, always write that down. If it's markup on selling, then selling is 100. If it's markup on cost, then your cost is your starting point of 100. Okay, and then the markup or the profit will always be whatever the percentage is that they've given you. And then the selling price is, or the cost is then the missing figure that you then have to calculate. But this basic calculation, selling price minus cost equals profit, is the basic calculation. That does not change. That always has to be true. Selling price minus cost equals profit. Okay. So in the second transaction here, we're using the perpetual inventory system, and this is what our markup calculation is. In the second one, we purchased goods. Okay, so we bought goods for cash. So that means bank account, 10,000 Rand. And we received a trade discount of 5%. So the total value of the goods that we purchased was 10,000 Rand, but then we were given a 5% trade discount. So remember also in your textbooks, there's that question where what is the difference between a settlement discount and a trade discount? So with the trade discount, we deduct the discount at the time of making the purchase. And our purchase will be for the total amount net of the discount. So the 10,000 is the 100% value of the selling price, but they gave us a 5% discount. So the actual amount that we paid is only going to be 95% of the 10,000 Rand. Okay, so your calculation will be 10,000 Rand times 95%, or you could say 10,000 times 5% and then subtract the 5% from the 10,000, or you can say 10,000 times 95%. Either way will give you the same answer, which means that the amount that you actually paid for your goods was 9,500. So our transaction is going to be for 9,500 Rand. So 3.2, we purchased inventory, and inventory is an asset, which is now going to increase. We paid cash for the purchase, which means bank, which is an asset, is going to decrease. So both of these are assets. So we need the asset column only. So inventory asset increase plus 9,500. Bank asset is going to decrease by 9,500. So the left-hand side of the accounting equation, the net effect is 0 because we increased it and decreased it by 9,500, which means the net total is 0. We had a net 0 change to the left-hand side, which means, again, we've got a 0 change to the right-hand side of the accounting equation. So we know our accounting equation is going to be correct. Then the third transaction, here we sold goods with a cost price of 1,000 Rand to Mr. Dlamkile on credit. Okay, so 3 important pieces of information. We sold goods, so we know that this is a sales transaction, that the 1,000 Rand that they've given us is the cost of the goods, and that we didn't sell the goods for cash, we sold it on credit. Okay. So remember, when we are using the perpetual inventory system, this is what's important. We always update our inventory account with any transactions that we've got. Okay, that means if we have a transaction that involves inventory, we do always record that transaction. So every time inventory increases or decreases as a result of a transaction, we increase or decrease our inventory general ledger account. With a periodic inventory system, we don't do any journal entries to the inventory general ledger account throughout the year at all. We only work out what its balance is at the end of the year. Remember, in the periodic inventory system, we use those expense accounts, purchases, what are the other ones? Purchases, railage, delivery costs, etc. We debit those expense accounts instead of debiting inventory when we purchase inventory. And when we sell inventory, only in the perpetual inventory system do we decrease inventory. And in the periodic inventory system, we don't decrease inventory at all. When we sell, when we make a sale, we don't have any sales, any inventory journal entry involved at all. Okay. I don't know if I can fix this. It was bothering me that this spelling, so weird the way one's brain can just completely. There you go, proprietary. See, I can get it right. Sorry guys, that was bothering me that I just went blank. It's funny when it's the same thing if I'm in class and I'm writing on the whiteboard. Sometimes when you're writing on the whiteboard, something just looks so different that your brain just does a loop and you can't, it doesn't look right. Okay, so sold goods, so we must do a sales transaction. So this means that we are going to have two journal entries to record. One is going to be the sales entry for the selling price on credit, and the second journal entry is going to be reducing our inventory for the value of R1,000 that we sold. So let's go and have a look at this on the answer, because this is going to be easier. Where are we here? 3.3. Okay, so let's do it like this. We've got transaction A, which is the sales transaction, and we've got the second transaction, or should I say journal entry B, which is the inventory journal entry. Okay, so there must be two journal entries every time you make a sale and you are using the perpetual inventory system. So the first journal entry is to record the sale at the selling price. So what did they give us here? They told us that our that the cost of the transaction was 1,000, and that our markup was, what was it? Where's the instructions? Our markup is 20% on selling price. So let's do the calculation on the side over here. No, let me go back over here where we've got this all already typed out. Okay, so here we go. Our cost, I don't think I'm going to fit it in underneath here. Our cost is R1,000, okay? And our cost is 1,000. So we need to divide that by 80, because cost is 80 parts. And I want to know what the selling price is. So divide by 80 and multiply by 100. And that will give me 1250, which is my selling price. Another way that you could have done it is say 1,000 multiplied by 100 over 80 equals 1250. So that's the maths that we've done to convert our cost of R1,000 into the selling price of 1250, using this equation that we wrote down at the beginning. So you can see how important it is that you write this equation down, so that every time you come across a transaction where you need it, you can just go straight back to your equation and fill in what you've got. So they gave us the cost, so we're putting it under the cost column, and then we can easily work out what the selling price is. So to record the sales, we are going to debit the asset, debtors control, so not bank, because it wasn't a cash sale, and we are going to credit the income account sales. Remember, dead click, assets increase on the debit side, income accounts increase on the credit side. So assets are increasing and income is increasing, so it's plus and plus. Then to record the inventory, we have sold inventory worth R1,000, so we have to reduce our asset account inventory by R1,000 because we no longer have that inventory, and we have to increase our expense account cost of sales, because that asset that inventory that was an asset now becomes an expense, because I use that inventory to generate this. Inventory was used to generate this sales transaction. So this inventory then becomes an expense. And then you can see my sales of 1,250 minus the expense of 1,000, I made a profit, a gross profit or markup of 250 Rand on that sales transaction. So in our accounting equation on this side, my asset inventory is decreasing and my owner's equity is decreasing. Remember also with owner's equity, don't really have a lot of space to type at the top here. Let me just put it in here. Owner's equity is made up of capital minus drawings plus income minus expenses. That equals owner's equity. Okay? So because my expenses are increasing, that is reducing owner's equity. So if I do it like this, C minus D and I minus E, you can see that drawings and expenses will decrease owner's equity and capital contribution and income will increase owner's equity. So C is a plus and I is a plus, drawings is a minus and expenses is a minus. Okay, so that is then our sales transaction. This one, students commonly get this incorrect, and they mostly forget that there are two separate journal entries involved. And remember that this is only when it is the perpetual inventory system that we're using, that we've got to record both of those transactions. Then 3.4, we paid cash for an advert in the local newspaper. So our bank account is decreasing by 300 Rand. And we are, because we are incurring an expense for an advertisement. So let's go and have a look at what this looks like. So advertising is an expense account. Bank, we know, is an asset account. So our bank asset is decreasing by 300 Rand. And our advertising expense, the expense is increasing, which has the effect of decreasing owner's equity. Remember, expenses, if my expense, any expense that I incur decreases owner's equity. And then the last one, the owner. So again, we have got a transaction between the business and the owner. So our proprietary account is going to be involved, which means either drawings or capital. And in this case, the owner took goods, which means inventory. The owner took some of the business's inventory for their own personal use. So that is definitely then a drawings. Okay, the owner, that's what we call drawings. When the owner takes either cash or goods from the business for their own use, we then have to debit that amount to drawings. But in this case, they have given us the selling price of the goods. So what do we have to do? We have to, we've got to take that amount that the owner took. We have to reduce our inventory. Our inventory is always carried at cost. So we need to work out what is the cost price of those goods that the owner took, because we will debit drawings and credit inventory with the cost price. Okay. So you've got to do that calculation as well. So again, have a look at the top over here. Selling price is 100, cost is 80, and the profit is 20. They have given us the selling price, which is the 100%. We want to work out 80 parts. Okay, so 500 is 100 parts. So if we divide that by 100, that will give us 1 part. And if we multiply that by 80, we will then get the rand value of the cost, which is going to be 400 rand. Or you could also have said 500 times 80 over 100, which is the same thing as saying divide by 100 and multiply by 80. Whichever way your brain works. Some people prefer divide by 100, multiply by 80. Some people like to say 500 times 80 over 100. Okay, do you understand what we're doing there? We are converting the selling price into the cost price using, again, this equation that we calculated right at the beginning of the question. So this again is a strategy that you're going to follow, is to write this equation down and then use it when you need to. Okay, so we've done our calculations. Now let's go and have a look at what our entries look like. So owner's account, in this case, the owner took goods, so it's going to be the drawings account. If the owner donates goods or cash to the business, then it's the capital account that's affected. If the owner takes goods or cash from the business, then it's the drawings account that is affected. So that's an owner's equity account, and inventory is an asset account. So our inventory is decreasing because the owner took the goods, and the owner's equity is also decreasing because we are charging the owner's capital account with the amount of the goods that he took. Okay, so remember again, drawings decreases owner's equity. Okay, so guys, I've taken a long time to work through these transactions because I know you will get them. You've had them in all of your assignments so far, and I know that the students battle with them. But remember, you can see with each of these transactions, I've talked you through how you can reason your way through the transaction as to exactly what you've got to do. You must use your dead click rules. You must use these rules here for owner's equity, that owner's equity is C minus D and I minus E. You must be able to identify whether each of these account names that you are debiting or crediting, are they an asset, a liability, or expense or income? And then you must be able to decide, is that account increasing or is it decreasing? Okay, plus all of your other rules. So just remember, in this particular question, they told us that we could ignore VAT. In the exam, they can very well give you a question like this, where the owner, the company is registered for VAT and only purchased from other VAT vendors. Okay, if that was the case, you would do your transactions like we did here with this example. In this example, they included VAT, which they shouldn't have because they told you here VAT can be ignored. But at least it gave me the opportunity to show you if VAT is involved in the question, then this is how you've got to take it into account. Okay, guys, it's nearly an hour and a half that we've gone through now. We've gone through these first 3 questions and I've done them in detail. So I'm going to end the session now so that this recording is not too long, and I will complete the rest of the questions of this question paper for you either tomorrow or Wednesday, and then post that for you as well, so that you definitely will have it before the weekend, so that you can carry on working through this exam paper for your revision. Okay. All right, so let me just go back to the Blackboard. Okay, David, are you still there? Very patient person. I hope this has all been helpful and that I've taken the time for these explanations and really tried to give them to you in detail. And I know it takes long, but at least you've got the full explanation. So I hope it's been helpful to you. Okay, great. Thanks, David, for sitting through this, and well done. And all the very best of luck for the exams. And remember, just ask questions if there's anything else that that you want to know. I'm just going to stop the recording now.